and good evening, everyone. Welcome to our monthly call where we connect with our investors. We take you all through how we have done in our strategies, what changes we have done, how our portfolios have been shaped up. And I'm really happy to share with every one of you that last 2 months and the quarters have been extremely good on our quantitative parameters and models. We have been able to maintain a healthy alpha over the last 1 year, month, 3 months, 6 months, and we have catched up a lot of performance as well. The right call by our quantitative models in terms of the sector selections, the correct selections of the style, and as well the portfolios which we always been telling everyone has done very very good for us and our investors as well. Mm, as you all know that the process of the call will be pretty simple, that will take you through how our quantitative models have done, what changes we have done in the model, what outlook we have. My colleague Siddharth Vora, who's the head of quantitative strategies, will help you explain one of the most important thing that has helped and changed, where must have gone unnoticed by most of the investors, is that our multi-asset product, which we run our quantitative platforms, which is known as multi-asset dynamic portfolios, have been able to beat most of the fund managers as the portfolios. The right time allocation to the precious metals have added phenomenal alpha, and that has created tremendous wealth. With the numbers that last 6 months, of portfolios have done upwards of close to around 17% absolute return, and even on yearly basis, the portfolios are net positive, and most of the portfolios have struggled to generate the alpha. During this call, Siddharth will take you all through AQUA strategy. He will also explain to how our multi-asset products have done, what are the changes, and at the same time, my colleague Sandeep will take you all through certain fundamental aspects, and at the same time, how he feels that the global market and the equities is going to be. So with this, I would definitely respect the time, and I'll tell Siddharth to take this call forward in terms of taking all through how our models and the process have done in last 1 month. We're looking forward more such participations in time to come. Over to you, Siddharth.
So good evening, everyone. Thank you so much for taking out the time and joining in. I think after a while, or maybe after at least couple of rough months, around Jan Feb, we now connect to talk on a positive note. We connect with a positive frame of mind. We have better numbers today backing us. So it's a good change, good change after a dull period over a long cycle. You have few dull periods. So after that dull period, the recovery period always, brings back energy, brings back enthusiasm and spirits amongst investors. And good for us that in the Feb and March webinars itself, we called with a lot of conviction, with a lot of data, with a lot of proof that we are heading towards a market recovery, at least in terms of Indian markets. And I think since then, equity markets have recovered at least meaningfully, 8 to 12% they've recovered since March. So markets are on a stable footing now. The stress around tariffs is also at least directionally coming down. Incrementally it's coming down. The dialogue is improving. The stance is improving. Things are turning a little more accommodative. Things are turning a little more uh, cooperative, so to say. So I think we are headed in the right direction in terms of our uh, global trade outlook. Of course, things haven't been resolved yet, but they are in the direction for resolution. So I think there is a big overhang for India. US rate cuts have also been, supportive for India and other emerging markets. Our valuations have been neutral for a while, in that choppy neutral range. So again, valuations still don't act as a meaningful deterrent to returns or to investor risk appetite, as I've been maintaining over the last couple of months, that valuations are neither euphoric nor dirt cheap or lucrative. They are somewhere in the neutral zone. And neutral zone is not always a bad zone, to be honest. Sometimes neutral zones are good zones for investors, to stay invested or to, add fresh capital. It's not necessary that every cycle gives you a correction where valuations become dirt cheap. Of course, we saw it in the very sharp corrections during Jan Feb, that valuations had gone even closer to the cheaper zones of market, but don't think we're meaningfully away from the neutral zone as of now. If I look at the broader setup of the market, we're in a much better risk environment right now. If you look at VIX also, there are two perspectives to India VIX right now. One is that we are at a very low in the 10 VIX level. That's a very low level. And we're coming out of a very high sort of VIX level. So the idea to understand about VIX is that we've been in an extremely volatile world probably since Trump has come in. And now that volatility, that uncertainty is coming off. At the current level, we have two interpretations. One, that the uncertainty is low. Two, there we could be hit by a bus that we can't really see right now, right? So when the markets become so complacent and that the VIX is around 10, we're usually saying that, okay, things are looking good, we are bullish. But at the same time, if something unforeseen happens, the market is not prepared to account for that uncertain, unforecasted source of risk or unforecasted source of volatility. So it's a double-edged sword, but given the market internals, given the breadth, given the recovery in sentiment, our sentiment indicator tells us that we were below the 25 percentile mark. We're now closer to the 45 percentile mark. So there's a marked improvement in sentiment, even from a risk appetite perspective. We were trading at the bottom 15-20 percentile. We are now closer to the 35-40th percentile. Again, that shows some stability, some improvement in terms of risk appetite. And finally, factor spreads have started recovering, which is very good for quant managers because we make money when factor spreads start recovering. We've come out of a cycle of extremely low factor spreads, which means all the factors are, doing equally good or equally bad. In a time like that, it becomes slightly difficult to generate alpha. But as factor spreads start improving, quant strategies also tend to generate alpha, which we've done in the past also. And again, in this recovery cycle, we are finally alpha positive on a 1 month, 3 month, 2 month, 6 month basis. So gradually our alpha has started to recover. That's a broad, overview on what has been up with the strategy. Some important changes that we've made in the portfolio have really worked out in our favor. The metal and materials overweight call has played out really well. The IT and healthcare exit also did quite well for us. Our financials positioning has continued to be a core, stable, outperforming allocation. Uh, Other than that, some ancillary positions, quite a few of them have done well, and few of them have, of course, underperformed. But we worked with a good 70% sort of hit ratio in the last 2 quarters or so. So overall, portfolio is getting back in a good shape. Performance is recovering. The models have, become in tune with the new world order. So things are looking better than before. Domestic flows keep a very strong flow for market despite intense FII selling. Crude has obviously been favorable for India as of now. DXY also has been extremely favorable for India and other emerging markets. So I think overall, the structure is looking decent to good. Of course, we've got a lot of new triggers in terms of GST, taxation, interest rate cuts, consumption revival. All of this is largely, intended to get baked in the quarterly earnings post this quarter. So we look at the broader cycle and we feel that earnings downgrades are likely nearing their end. The upgrade cycle is starting. So we could see, good 7-8 quarters where Nifty earnings are likely, I mean, equity earnings are likely to recover, and the current, sub 10% growth likely to bottom out. So things are looking better, and happy to know, stand at a place where incrementally the view is more constructive. As I said in my recent interviews also over the last, 1.5 month, that after a very long time, We are bullish in the short term, in the medium term, and in the long term. And it takes a lot of data points to converge for us to sort of build that view. Of course, one doesn't rule out any volatility or unknown swings, but after a very long time, we are bullish on the short term, medium term, and long term. Happy to now bring in Mr. Sandeep Nima as well to share some of his views on what he's making of in the market and what are the macros telling us. Sandeep, over to you.
Sure, Siddharth. I'll just introduce Sandeep also. Hi, everyone. Sandeep is part of our team. He's been with us for now more than 3+ months. Some of you would have definitely interacted with Sandeep. Some of you would have not, but definitely we'll soon keep a separate call also. Along with Sandeep, we have started a non-discretionary PMS as well. I'll send across a detailed email of how that product's going to shape up and what kind of value add that we look. But Sandeep definitely comes with 30 plus years of experience in financial sector, veteran, and having a very good understanding of markets, portfolios, and he's been managing portfolio not only in India but across the globes as well. So welcome you, Sandeep. If you could just take this call forward, thank you.
I think Sandeep hasn't been added to the panelist group. Can we ensure he gets added to the panelist section?
Just a sec, I'm just calling. Yeah.
Till Sandeep comes in, I'll also give you guys a brief update on our multi-asset strategy for the investors who've been with us in our multi-asset strategy. Fortunately, we our models took a call on gold, aggressive call on gold, close to 1.5 year before. So we increased allocation first from 10 to 25 and then to 30%. So over a year now, we've been managing a 30% sort of gold allocation in our multi-asset strategy, along with a very diversified equity allocation. And that strategy has played out really well. Of course, it's for a different risk profile, it's for a different return profile of investors. But over 3 years, we've done a consistent sort of 14 to 15% return with a 8.5% volatility. Just to give you perspective on what 8.5% means. Usually, equity strategies have a volatility of close to 19 to 20%. And in a period like that, having a 8%, 9% volatility along with a 14, 15% return profile, that is very, very lucrative for investors who want to sleep peacefully, avoid volatility at the same time, get in some inflation beating, FD beating, index beating returns. So that's just a broad update on our multi-asset fund as well.
Hi, Sandeep. Sorry for all this trouble. It's all yours. Please take it forward.
Yeah, okay. Am I audible?
Yes, you are. Yeah.
Okay. Thank you and good evening, everyone. So basically, Siddharth has just briefly talked about the macro and the markets where we stand. I'll dwell a little more deeper into that. So if you just go back to the global macros with US in what's happening in the US economy. So we saw that in the last meeting, Fed did not cut rates. This was in line with our expectations. So US is now in a situation where inflation is inching up and an unemployment rate is also inching up. So that's like a very catch-22 situation for Fed. And in our forecast, we feel that we won't get any rate cuts at least in 2025. And the economy continues to slow. And as we enter 2026, we will see a slowdown in US economy as well. So therefore, and then probably we'll see Fed cutting rates aggressively to shore up the economic growth. So looks like a choppy time for the US economy. However, in the US, the other part is that if you look, the markets continue to scale new highs, and the market momentum continues to be strong, and that is driven purely by it's a concentrated kind of a market where top 20, 30 stocks, which are AI driven tech stocks, are taking the whole market up, and that's like been there since the beginning of the year, as we know. So, and this should continue for some more time, I guess, because the AI-driven rally, where a lot of capital investments are being made uh, into the AI sector, will probably continue to keep the market in an elevated state. So overall, in nutshell, the economy continues to slow. Fed may not cut this year, and even if they cut, it will be at best 25 basis. This is ours is like a non-consensus call because the market is expecting some cut in the next Fed meet. Market was expecting a cut in the last meet as well, but it did not happen. So overall economy continues to slow down, but market will probably continue to remain elevated, driven by the AI rally. So that's on the US market. In that backdrop, India has done relatively well. Indian economy stands relatively on a stronger wicket. So if you see since 2025, what we have seen is that there have been a lot of policy changes which will probably reflect in a stronger growth going forward in the second half as well as in FY27. So what are those changes? First was in the budget there was IT cut, and there was this cut should actually spur some consumption maybe with a lag of 1 or 2 quarters. Second was that we have seen RBI cut almost 50 basis point in the June policy meeting. And before that, they had done another 50 basis. So in the last 12 months, we have seen 100 basis of interest rate reduction. And then we have the most recently we had the GST reforms, which is also going to impact the consumption in a positive way. So overall, if you see this backdrop where there is some amount of money in the hands of the consumer with the IT and the GST cut, and also the rate cuts, which will probably manifest itself into a stronger credit growth cycle going from second half onward. So economy is on a stronger wicket. Monsoons have been pretty okay. Some patches have seen a lot of floods, but otherwise monsoon has been okay. Uh, GDP has continued to remain strong at 6.5, 6.7% range. RBI, in fact, in its last policy meet has revised upwards their GDP forecast for second half to 6.8%. In our estimate, this forecast should also be beaten, and we probably could inch up close to 7% of growth, driven by GST reforms, driven by strong credit growth we see in the second half of this year. So overall, Indian economy on a stronger wicket. We see that FY27 would also be 7% kind of a growth, and all the policy measures that the government has taken will reflect in the stronger economic growth. Inflation, in our estimate, again, inflation will inch up slightly as we go along in the second half and in FY27, and we all again do not expect a significant policy action from RBI. So RBI also will probably be on hold, as we saw in the last policy meet, they kept on hold. And uh, the impact of all the measures that they have taken in the last 6 months should actually benefit the economy in a positive way. So we feel that India is now on a stronger wicket, much stronger wicket. Some of the hiccups that we have seen in terms of the H1B visa issue, the tariffs issue, they are probably digested, and they will have some impact, but not a major impact, and they are more sector specific rather than economic wide impact. So overall, apart from some of these chaotic issues that we had in the last 1 or 2 quarters, I think we are probably in a stable wicket now from from that perspective, and growth continues to inch up. So overall, positive backdrop for economy. Coming to the market, so how do the market look like? In the last 2 quarters, we have seen earnings growth actually have been below expectation. We have been in a constant earnings downgrade cycle since last 4 quarters actually, and we feel that now in the last quarter, which was the first quarter of FY26, we probably have reached the bottom of earnings downgrade cycle. And beginning this quarter, when the results have started coming, I think we probably start seeing some earning upgrades. Now, earning upgrades would come from 2 or 3 sectors primarily. The banks, which had taken the maximum hit in the last 3 or 4 quarters, so that they should see a significant earnings upgrade, and some of the other sectors like IT, industrials, they will slowly see some earning upgrade. So overall earnings upgrade cycle should begin now, and that is positive for the market, because market large part of the market correction or the stability or no returns in the markets in the last 12 months was also because earnings growth was very poor. There was no earnings growth. But now with second half onwards, we will see earnings growth driving the market multiples and market returns. So if you look at our estimate, earnings growth for FY26, in the first half, it was probably sub 10%, and which should inch up now to 12 to 13%. And as we enter FY27, we will probably see a kind of a mid double digit earnings growth of 14 to 16%. Market consensus is still low, as I said, but as we go along, this should actually get upgraded. And at 15-16% kind of an earnings growth for FY27, valuations do not appear very expensive. In fact, in the last 12 months, with Nifty not going anywhere, market valuations have corrected. There has been a time correction. There has been a actual absolute correction in valuations. Valuations now are at all the average of last 10-15 years, which is about 19 times forward, and that doesn't look very expensive. So earnings growth coming back, valuations at now back to the average level, long-term average. And third is the positioning. So if you look at the positioning of foreign investors, we all know that every day we see a negative number of foreign selling. Now, that what has it done is that in all the foreign portfolios, India is now has an underweight position. And this is the first time in the last, let's say, 2 decades that India has an underweight position. And the underweight position is maximum in last 20 years. So that positioning is very light. So which means that at some point in time, as we enter the third quarter, we are already into the fourth quarter now. As we enter this towards the end of the year, and foreign investors take stock of their positioning vis-a-vis 2026 numbers, we will see some kind of a mean reversion where foreign investors cut their underweight position. That itself, we should see that the net flows of foreign investors should turn positive as we go along. So positioning light, and domestic flows continue to be very strong, driven by SIP numbers, uh, and that actually sets a floor to the market. So now, if you look at the market earnings upgrade cycle to begin, valuations at long-term average, they have corrected. Uh, Positioning of foreign investors at all-time lows, and domestic flows continue to be strong. So that probably sets a stage where we should see a strong rally into FY27, as we go along over the next 2 or 3 quarters. So we think that the market is now at a stage where it is time to steadily increase allocation to equities and in terms of sectors, so sectors where we feel that the rally will be uh, 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 led by would be first metals. We have been bullish on metals for quite some time, and they continue to do well. They continue to outperform Nifty and most of the other sectors. The other sector is banking, as I mentioned. Banking, the whole financial services space, so banking, NBFCs, which again, as I mentioned, had seen very negative earnings growth in the last 2 or 3 quarters. So that should turn around now, and banks and NBFCs should be the other sector which should lead. And then we have the industrials, which where we feel that the manufacturing sector itself as a whole would also participate in the rally. So these three will be the strong sectors. Of course, there will be bottom-up stories in different sectors. IT at some point in time would bottom out, but let's wait for this quarter and see how the results are and what the commentary is right now. The macro outlook for the IT customers is not very positive, as I talked about US slowing down. So let us wait and see. But there will be opportunities. Overall, looks like a bullish setup for the market, and we look like we probably are in for a 20% plus rally over the next 2 or 3 quarters. Yeah, thanks.
And just to add to what Sandeep said, so India has been the sole underperformer. When you compare India to other emerging markets, when you compare it to developed markets, and when you compare it to precious metals, or for that matter, even bonds. So Indian markets have underperformed all asset classes and all other equity markets. So it has been that last 12 months have been an outlier underperforming period for Indian equities. But that we need to put perspective that if you look at the 5 year cycle, we had 4 outstanding years before that. So every year obviously can't be like that. So every once in a few years, it is good that Indian markets take a break, take a breather, take a pause, things consolidate, and then create space for the next rally to emerge. So I think this is the broader insight for all investors, that every strategy, every asset class, and every market will tend to go through cycles. In that cycle, you will have to demonstrate some sort of patience and understanding that every year, this is an equity strategy. So every year can't be 20% plus. When we look at an equity strategy and say numbers, okay, the long term capacity or the long term intent of the strategy is to deliver in the 22 to 25%, it does not mean every year we want to deliver or every year we can deliver 22 to 25%. Over a 3 year, 5 year cycle, we intend to deliver those kind of numbers. And it's an average of good years, flat years, bad years. Even if I look at where we stand as of today, since inception, we're closer to the 24-25% mark, and the alpha continues to be in the 6 to 7.5% mark, which is in line with the long-term back-tested results of the strategy also, where the returns are in the range of 23 to 27%, and the alpha is in the range of 5 to 8%. So yes, in this, we try to stay towards the higher end of performance. But as you know, markets cannot be predicted to the final detail, and so we try to stay on the right side of the market. We try to stay in the right sectors. We try to keep our factor profile aligned to market cycle, and therefore hope that the model generates alpha by taking the right top down calls, which is asset call, cash call, sector calls, factor allocations, sometimes the portfolio beta positioning. When do you want to be high beta versus low beta? Not sure if investors went through the last 6 newsletters where we've been month on month gradually increasing portfolios beta, reducing portfolios average market cap, which is again a quantitative indicator and a sign that our portfolio is turning more aggressive, it is turning more constructive, and we are trying to convey a bullish positioning with our portfolio. So if the average market cap is going down, that means we're trying to increase small and mid caps. If the portfolio beta is going up, it is again positioning us as a higher beta strategy in this recovery cycle. And finally, after 6 months, the high beta versus low beta spread has turned in favor of high beta. We obviously called it a bit early when it had started turning at the lower deciles, but it's already turned now. And the other thing is, given that India has been such an underperformer, relative underperformer versus other markets and asset classes, it has created space now for India to catch up in terms of outperformance over the next 12 to 24 months. Yeah, so that's about it, Sandeep. I just wanted to add this one point.
Very well said, Siddharth. Thanks, Sandeep, Siddharth. Now we'll invite question answers from participants. If you have any questions, please feel free to ask us. We'll be able to answer all your questions. Maybe during our last call and even call prior to that, Siddharth and I have been very vocal that you need to look at your portfolios. You need to top up at the right time. It's not possible that you will always be able to get the bottom. But since then, since the portfolios are resilient, we have now been completed for more than 26 months. We would definitely urge all investors to consider either topping up or, if possible, putting up fresh investments. We are always there. But having said that, if you have any questions related to strategies, please put it in a chat box and we'll be able to answer them. Thank you. We'll take the questions one by one. Okay, so the first question is somebody wants to understand the sectorial view, where he wants more view on what's our call on the gas sector. Sandeep, I would suggest if you can take oil and gas a little bit about it. What's our view on OMCs and overall on oil and gas sector?
So, see, what has happened in the last 1 year is that crude has actually corrected quite a bit. So, this obviously is positive for India. But whether crude stays here at around $65 Brent or not is a question mark, right? Because oil and gas sector is linked to crude prices. Uh, our view is that from here on, we have seen the bottom in terms of crude prices, I guess, and there could be some amount of uptrend in crude prices. Having said that, how do you position in the sector? So obviously, as crude prices go up, it impacts the oil marketers negatively, but it has a positive impact on the oil producers. So that's how I would probably put it on as far as oil and gas sector is concerned.
Sandeep, we have another question which is very favorite of your point. There's a question related to USD INR, and I'm sure if you start talking about it, you will require 3 more hours. But having said that, somebody wants a view on USD INR. Siddharth, you are also free to take.
Siddharth, you want to talk about it? You can come in. Okay, so let me take that. So USD INR, we have seen DXY, dollar index actually, if you see, correct from 105, 106 levels all the way to 95, 96, and now it is inching up. And as dollar inches up, we have seen that most of the currencies, emerging market currencies, have weakened. Indian currency has also weakened. Rupee has also weakened. And I guess that with all the chaos that is happening across the world, we will probably see in the short term a dollar continues to strengthen. So we will see some rupee weakening as well as we go into into the last quarter of this calendar year. But over the longer term, which is if you are asking me, so this is a short-term view that rupee will probably depreciate from here as well. But over the longer term, I think there is an issue. We are probably in a phase where there could be some reset of the entire financial world as we see it, and where dollar has been the critical component of world's reserve currency. That probably we could see some changes there, and therefore over the longer term dollar probably should weaken, and that implies that rupee would strengthen. So that would be my view.
There's question related to, so there's a lot of question related to the sector. So let me first make you all understand that under our quantitative strategies or quantitative models, our broader calls are on style of investing. So first we look at that what style will fit or suit this current market. Then style we come to the right sizing of the sectors, and then comes the stock. So we it's not that we don't look at the stocks, but probably more than a stock, our quantitative models are designed in a way to first look at the right style of investing and then a sectoral allocation. There's a question related to pharma. We have been underweight pharma as we speak today. Also, probably pharma is not the large or the huge part of our portfolios, but Siddharth can help you all understand a
Sure.
little bit more about why we've been underweight on pharma.
Yes, so I think the way our quant model makes investment decisions. So there are a couple of parameters that we look at. So in a given market cycle, what is the risk that we want to take? Do we want to create a higher risk, higher beta portfolio, or a lower risk, lower beta portfolio? That is one decision. Then we take a decision, the model takes a decision on the market cap mix between large, mid, and small. That also kind of builds in the level of aggression we want to have in the portfolio. Then, where there are various style factors that the model considers for stock selection, such as quality, growth, value, momentum, volatility, dividend, etc. Third decision is how much weight or how much importance to give to which factor. Then the sector strength and sector risk is analyzed. Based on all of this together, the outcome of this is which stocks come in. So our process is top down rather than bottom up. We take a call, the model takes a call on risk, sector, factor, and size rather than take a call on which stock they want to buy. Stock selection is an outcome of selecting other parameters or fixing other parameters rather than the first form of action. Having said that, over the last 6 months, the model has turned gradually a little aggressive, a little higher risk, and a little higher beta. So therefore, our IT and pharma allocations have been getting trimmed and pruned month on month. So currently, we're not very constructive on both these sectors because we believe markets are in a steady footing, they are in a recovery cycle, and we should take higher beta bets rather than lower beta pharma, staple, or IT bets. And therefore, we are currently underweight pharma. And mid and small cap constitute roughly now 60% of the portfolio, 60 to 63% of the portfolio. So that was another question. And large cap is closer to the 35-40% mark. As I highlighted especially that the average market cap of the portfolio has significantly come down. Mid caps obviously dominate the portfolio, with small cap being closer to 20% and large caps being closer to 35-38% now.
Fair enough. I think we have taken most of the questions we
Yes.
have. Which are the sectors in focus in? Okay, so which sectors are in focus? Sandeep has already put for the metals where we are very, very, very bullish.
So
Metals still.
materials, which includes the broader ambit of metals, mining, cement, that's one focus area for us where, we are building in positions, we have positions. The other area is financials. Now, within financials, we expect some sort of rotation. Currently, our positioning is asset management companies, capital market plays, NBFCs, and insurance companies. This is our current financial positioning. We've already, over the last 10 days, built a good 10-12% allocation in banks, mainly PSU banks. So we believe this is likely to continue for some time, where we prune down defensive financials and add a bit more of high beta financials like PSU lenders and banks. So that is the second piece. Other than that, we've already built some position in auto. We have roughly 10% in auto. that might also inch up, towards the 13-15% mark. So materials, mining, that is one. Financials, within that, some internal rotation could happen. That is second. Uh, Automobiles would be third, and some sort of consumer discretionary. So that is how the broad portfolio will be constructed. It is already in that, but some more minor changes are in the process. So I hope that answers your sector positioning question.
If Siddharth, you have answered most of the questions that were there in the chat board. Before we conclude the call, and wish you all a very, very happy festive season. We are always available for one-on-one discussions or the personal call if you want to discuss more about your portfolios, about the investments. Every one of us are available, me, my team, and wishing all our partners, investors, a very happy and healthy festive season. Thank you, everyone. Thank you, guys.
Thank you
Any
so much
closing
for that.
remarks, Sandeep, Siddharth, you want to do, or shall we
Stay
close?
invested, use market corrections as an opportunity to rise over your emotions, increase allocation to equity so that over a 5-year, 10-year cycle, you've earned alpha just by using corrections to build your equity. And somebody gave me a very good example, and they told me also that it's patented by me. So they said every time there is a sale in a mall or on Amazon, buyers rush to buy. But when there is a sale in equity markets, people are fearful. ऐसा नहीं होता है कि मार्केट का प्राइस नीचे आ रहा है तो और नीचे ही जाते जाएगा. Always use discounts and sales to load up rather than wait for a further deeper discount. So I think I'll leave you guys with that thought.
Yep. Okay. Thank you very much, everyone, and wishing you a very happy Diwali.
Thank you.
Thank you.